What if I told you the cup of coffee in your hand might be your ticket to finding $1 million stock? Not because coffee itself is enchanted, but because it signifies something larger, an idea espoused by one of the world's greatest investors, Peter Lynch. He didn't use insider information or Wall Street rumors. He just observed what people were doing, what they were buying, eating, wearing, and drinking. He thought the typical shopper knew more about winning stocks than most experts. Within 13 years, Peter Lynch transformed Fidelity's Magellan Fund from $18 million to over $14 billion. His secret was not in elaborate charts or insider connections. It was in supermarkets, shopping centers, and yes, even coffee houses. He taught us that with a dash of common sense and observing the real world, anyone had the potential to uncover fantastic investment opportunities. Companies he referred to as 10-baggers, which bring back 10 times your original investment. Now, we're dissecting his classic insights from One Up on Wall Street and connecting them to the world you see today. Peter Lynch thought you didn't require a finance degree to beat the market. You simply needed your eyes open. He asserted the average investor tends to have a real edge over Wall Street. You live in the real world. You witness the next big brands before they make the headlines. You see, when others begin gathering around a new restaurant chain, when a small retail store expands to more locations, or when a product becomes present in every checkout cart, Lynch regarded all of this as good investing intelligence. All you need to do is observe it. Let's reference that coffee illustration. Let's say you see a new cold brew brand taking off from the shelves at your local supermarket, and then you notice folks talking about it on the internet. It's kind of in your gym's fridge. And now you can see they're opening up cafes in new places. That kind of velocity? That's signal stuff, according to Peter Lynch. Something to stop and think. Who produces this? Is it a public company? What are the numbers behind it? If the basics pass the test, strong profits, manageable debt, faithful customers, then you could have a future 10-bagger right there. This strategy seems almost too easy, but it is effective. Lynch built a system for finding great companies early on, and it began with something he termed buy what you know. You don't have to invest in tricky businesses or high-tech companies you can't understand. Rather, he suggested beginning with the products and services you use and believe in. Your favorite sneakers, go-to meal kit, viral skincare brand. Those are all possible leads. Curiosity is the door to investing success. After you identify a product that catches your eye, the next thing to do is find out about the company. Who owns it? Is it publicly traded? What does their long-term growth look like? Lynch stuck to the fundamentals. You don't need to be a spreadsheet wizard, but you do need to know if the company is profitable, steadily increasing, and not getting too deeply in debt. If a company has great earnings, a straightforward model, minimal debt, and a differentiation advantage, be it in product, marketing, or customer stickiness, you may have a long-term winner on your hands. Lynch also used to classify stocks to know what to anticipate. He placed them in 6 categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Slow growers are usually big, stable firms that grow modestly year after year. They're dividend winners, but aren't coming with tremendous upside potential. Stalwarts are better. They're strong, steady growth firms such as Johnson & Johnson or Coca-Cola. They won't knock your socks off, but they won't blow your portfolio apart either. The true gems, though, are fast growers. These are the little fighting companies growing 20-30% annually. This is where Lynch accumulated some of his greatest profits. They may not look impressive on first glance, but their momentum and flexibility can be phenomenal. Cyclicals are companies such as airlines or car makers, companies that prosper when the economy prospers but falter during downturns. Turnarounds are companies that have suffered a setback but are turning themselves around. And lastly, asset plays. These are companies that hold valuable assets the market hasn't fairly valued, such as real estate or patents. Most of Lynch's top-performing investments were from the turnaround and the fast grower groups. But more significant than the group was when he got in, well ahead of when Wall Street eventually warmed up to them. He believed in what he observed with his own eyes. He also believed that everyone has a unique edge. A teenager might know the next big clothing brand before any analyst. A teacher might notice which education apps students can't stop using. A nurse might spot a promising new medical product before the company even appears in financial news. These everyday insights are gold, if you know how to act on them. One of Lynch's best-known investments was one he made for his wife. She informed him of Leg's pantyhose, which had begun to sell in supermarkets and took off like wildfire among women. Lynch reviewed the company's financials, was impressed with what he saw, and invested. It was a multi-bagger. The lesson? Watch what real people enjoy and use. Then do your research. So how do you do the homework? Lynch says a great company must have a straightforward business model. If you can't tell in 2 sentences how the firm makes money, it's likely too complicated. You also want to see excellent earnings growth year after year, not a one-time fluke success. Low or tractable debt is also important. Too much debt will topple a firm, even if it's growing. Second, consider whether the company has a competitive advantage. Is it dominating a niche? Does it possess a unique product, brand, or pricing model? Also, look at insider ownership. If the founders or executives control a large portion of shares, they have skin in the game, i.e., they're more likely to act in shareholders' best interests. And lastly, ensure it's fairly valued. Even outstanding companies can be disastrous investments if you overpay. Suppose you came across a fast-growing smoothie chain. You've noticed new stores opening. The places are always busy, and everyone's talking about it on social media. You dig. They're making money. they're growing regionally, and the founders still hold 30% of the company. If the price isn't irrational, you might just own your own 10-bagger. But don't get too worked up too quickly. Lynch also had some stern warnings for investors. First, don't believe the hype. If somebody's selling you a once-in-a-lifetime penny stock on YouTube or Twitter, run in the opposite direction. If your cousin mentions that he heard from a friend that a biotech firm will triple next week, forget about it. Real investing doesn't function that way. Also, don't try to time the market. Lynch believed more money is lost by people trying to anticipate market corrections than in the corrections themselves. Focus on the business, not the headlines. The market might fall tomorrow, or it might rise. But if your company is growing and generating profit, you're already in a good position. And one last thing, you've got to like the product, but liking the product isn't sufficient. You've also got to check whether the company itself is sound. A food chain may have wonderful grub, but if it's in the red or drowning in debt, it may not be a sound investment. Utilize earnings reports, balance sheets, and competitive analysis to make your choice. Let's discuss some of Lynch's actual successes. Dunkin' Donuts. He saw long lines in front of stores each morning. Solid business, straightforward idea, loyal customers. Taco Bell, a rapidly expanding franchise then with a business model that worked on a national scale. Legs, spotted by personal observation. Strong demand, solid distribution, tremendous consumer affection. Fannie Mae, a turnaround on which Wall Street had lost hope. Lynch recognized the potential and benefited from it. These weren't covert underground businesses. They were open to view. The distinction was Lynch paid attention. And in the modern world, the potential for paying attention is greater than ever before. With TikTok, YouTube Shorts, and Instagram, consumer trends are being exposed in real time. A viral skincare product, a spike in interest in small batch home decor brands. These trends can blow up faster than ever, and savvy investors are paying attention. A single trend moment can spark a multi-quarter growth run in a public company. If you remain vigilant, you may catch a wave early. Yet another fantastic example is how Gen Z consumer behavior is redefining retail. If you see a generation rushing to resale sites such as Poshmark or Depop, or adopting new payment systems such as Buy Now Pay Later via Afterpay or Affirm, that is not merely cultural, it is investable. Lynch's approach still holds. Notice the trend, see if the company is listed, and get into the numbers. So how do you put it all to use? Here's a straightforward 6-step methodology based on Lynch's school of thought. Compile a list of your most admired products, services, or shops. Find out if they are owned by any public company. Study the fundamentals, revenue, debts, margins, and growth. Classify the stock, fast grower, stalwart, turnaround, etc. Invest with a small amount and be willing to hold. Monitor the business, not the stock price. Assume that you are an exercise buff and see a protein supplement company go crazy. You read online reviews. 5 stars across the board. You research the company, and lo and behold, they're publicly traded. They have growing profits and are expanding overseas. That might be a good investment. Or perhaps you're a programmer and your colleagues are constantly discussing a new piece of software. It occurs to you that it's owned by a small cap company that is expanding 25% annually. It's profitable, well run, and you know the product inside and out. Another Peter Lynch type situation. And don't overlook international opportunities. Most investors will look only at US companies, but developing markets are full of brands experiencing their Starbucks moment. A neighborhood food delivery app is growing throughout Asia. A low-cost carrier is taking a huge hold in India. If you have connections to other cultures or travel overseas a lot, you might see winners nobody else has yet. That's your advantage. Don't forget, you won't be right on all stocks. Not even Peter Lynch was, but the few that you are, they'll pay for all the rest many times over. The beauty of one 10-bagger is that it can make your whole portfolio multiple times larger. A $1,000 investment grows to $10,000. A $5,000 investment growing to $50,000. That's the kind of long-term wealth Lynch thought anyone could build. So the next time you sip that morning cup of coffee, look beyond the flavor. Who produced it? Who's cultivating? Who's growing while others contract? The world around you is full of stock ideas. You just need to notice them before the rest of the world does. So the next time you take a sip of your favorite cup, ask yourself, is this merely coffee or the start of your investing career? Peter Lynch didn't seek out genius-level forecasts. He sought out products people adore, strong numbers with companies and businesses that are in plain sight. Then you do that. If this video did change your perspective about the world, leave this video a like, subscribe, and comment on what brand or product are you crushing hard on right now. Who knows? It could be your next 10-bagger. Turn on the bell so you never miss another episode where we simplify investing and turn common sense into financial success. Until next time, stay curious, stay sharp, and remember, the next $1 million stock could already be in your fridge, your phone, or your coffee cup.